In this week's video, we're going to be talking about the difference between cash basis accounting versus accrual basis accounting. Whether you are a small business owner or an entrepreneur, it's important to know the difference between cash basis accounting and accrual basis accounting. Hi, welcome to my channel. My name is Irene and I'm a CPA here in Canada. I post videos explaining important accounting and tax concepts using simple language to help business owners gain financial clarity. Make sure you hit that like and subscribe button for more. So let's first talk about cash basis accounting. Under this accounting method, transactions are recognized when there is a change of cash. So revenues are only recognized when payments are received, and expenses are only recognized when payments are made. So for example, let's say you provided a service to a client in January. However, the client didn't pay you until March. So under the cash basis of accounting, you would recognize the revenue in March when the payment was made, even though the service was rendered or completed or delivered in January. On the other hand, with accrual basis accounting, under this accounting method, revenues are recognized as they are earned and expenses are recognized as they are incurred, regardless whether or not cash was received or if cash was paid. So this means that revenues are recognized when it is earned, not when it is received, and expenses are recognized when they are incurred rather than when they are actually paid for. So for example, going back to that same example, you provided a service in January and your client doesn't pay you until March. Under accrual basis accounting, you will recognize the service in January because that is when the service was rendered, delivered, etc., even though you got paid in March, months later. The Canada Revenue Agency, the CRA, requires businesses to report under either the accrual method or the cash method for their financial reporting. Most small businesses in Canada report under the accrual method. Some companies are able to report under the cash method if they meet certain criteria. So here are some examples of expenses and accruals. So let's say rent expense. Let's say you sign a lease for the building in December and your first rent payment will be due in January. Under the accrual method in December, you're able to record the rent expense because that is when it's incurred, even though you make the payment in January. Another one is accounts receivables. So going back to the previous example, if you're invoicing your client in January and do the work in January and they pay you in February, then under the accrual method, you will record the revenues in January is when you deliver the service. And so from January to February, when you're waiting for the payment to be received, that is going to be called an accounts receivable. And then vice versa with accounts payables. So if you purchase some items from a supplier and they invoice you, let's say January, and you pay in March, you can record the expense in January if you've received it in January and used it and whatnot, even though you paid for the expense or settled the bill in March. That is an accrual. So under the accrual basis accounting, this method will match the revenues with the respective expenses to provide an overall more accurate picture of a company's financial position at any given point in time. This can lead to better long-term planning and forecasting because of the matching principle between the revenues and the expenses. The matching principle is a fundamental concept within accounting which states that expenses should be recognized in the same accounting period as the revenues that it helped to generate. This means that when you recognize a revenue, you should also recognize the corresponding expense within the same accounting period. By doing so, this will help make sure that your financial statements are accurately reflecting the true profitability of your business within any accounting period. If you have a business that holds inventory, the matching principle is really going to come into play here. Let me illustrate an example for you. Let's say you own a clothing store, okay? And you purchase $10,000 worth of t-shirts that you're going to be selling in your stores. Initially, when you purchase those $10,000 worth of inventory, it's going to be classified as an inventory asset on your balance sheet, not an expense on your income statement. Now, let's say you sold one t-shirt. That one t-shirt costs you $10 to buy from your supplier. So as soon as you sell that one t-shirt, how that's going to look like in the accounting world is that your inventory asset of $10,000 is going to minus $10. You're going to remove it from your inventory account. And then that cost is going to be then added onto your income statement as a cost of goods sold expense. At the same time, you're going to recognize, let's say you sell this shirt for $30. You're going to recognize revenues of $30 minus cost of goods sold of $10, which is the cost you spent to buy the t-shirt that you sold. Now the gross profit is going to be $20. So you see how the matching principle here matches the exact expense with that revenue that it helped to generate, right? If the matching principle wasn't there on your income statement, you would fully recognize the $10,000 of the inventory assets that you've purchased, even though you haven't sold it yet. And now you're going to be at a loss because you haven't sold the shirts yet, but you're over recognizing the expense. So that is where a lot of people get kind of confused as well too. So the matching principle is really what is going to help provide a really good picture of the financial position that your company is in at any given point in time. Accrual basis accounting is the standard method of accounting used by most businesses, and it conforms to GAAP, the generally accepted accounting principles. On the other hand, for cash basis accounting, this is typically a more simpler method because you're just tracking the inflows and outflows of cash, and that's how you're recording the transaction. Cash basis accounting may also be good for tracking your cash flows because that is literally what you are looking at in order to record your transactions. So in summary, both of these accounting methods have different advantages and disadvantages and whatnot. Overall, it's really good to kind of know what is available out there and the differences. Generally speaking, your accountant will be able to help you with these matters as well as your bookkeeper. Thank you so much for watching until the end of the video. Please make sure to hit that like and subscribe button for more. Over here, YouTube thinks that you're really going to like this video, so I'll meet you there.